All right, so today's class is an important one, right? So we're continuing on our journey of learning the forex market, basically understanding the forex market in such a way as to be able to navigate the market successfully and profitably. That's our goal. Our goal is to be able to navigate the forex market successfully and profitably. You know, so when you are very shallow in knowledge in the forex market or about the market, there are things that happen in the market and you start wondering, why is this happening? Or why did this happen? Why is this happening? Why did this happen? I thought I got this trade right. I thought my analysis was good. So what happened? Why did this trade turn around? Or why did I enter these two trades and one of it went my way and the other one didn't go my way, right? So that's the concept. That's where the concept of currency correlation comes from. Okay, so the idea basically is that there are currencies and commodities that seem to go in the same direction. We know that when you want to trade in the forex market, whether you're trading commodities, you're trading gold commodities, you're trading currencies, you're trading cryptocurrencies, you're trading indices, you're trading stocks, CFDs, whatever you are trading, the market goes up or comes down, right? And because you're trading, you can make money whether the market goes up or the market comes down, right? So the concept of correlation, like I said, comes from the idea that some pairs, some currency pairs and some commodities tend to move together in one direction, all right? They tend to move together in one direction, and in some cases, some tend to move in opposite directions. So you want to know which currencies move in the same direction and which ones move in opposite directions, all right? Because if you have two currency pairs, let's say you have Euro USD and you have USD CHF, and these are two currency pairs, and you just see them from at face value, and you say, oh, these are two different currency pairs, Euro USD, USD JPY, right? These are two currencies. So you might come on the chart and you feel that, oh, I'm seeing a buy signal on USD JPY. Sorry, I'm seeing a buy signal on Euro USD, and then you look at USD JPY and you see I'm seeing a buy signal too on USD JPY. So, but when you have an understanding of correlation, you know that it's not possible for Euro USD to be buying, to give me a buy signal, and USD JPY give me a buy signal at the same time, right? Because the truth is that if I buy Euro USD and I buy USD JPY at the same time, one of them is like a self-fulfilling prophecy. One of them will win and the other one will lose, guaranteed. One of them is going to give me a win, the other will give me a loss, irrespective of what I think the signals might have given me, right? So this is where correlation comes from, and this is something you cannot understand from the surface. If this happens, for example, in this scenario I just gave now about Euro USD and USD JPY, excuse me, if you actually took those trades, what was that? Can you hear me? Sorry, I have to leave for prayers. Okay, fine, that's fine. All right, so now if that actually happens in a real trade, where you buy Euro USD and you buy USD JPY and one wins and one loses, you will be confused. You'll be like, oh, what happened? This signal seems like a very strong signal, right? My strategy gave me this trade, and then why did this one go right and why didn't this go wrong? Why did this go right and the other one didn't go right? Right? Now, sometimes some people will ask those questions, and some other people will just take it as one of those things and move on, right? But there's something someone I learned from someone a long time ago. He said, whenever you take a trade and that trade loses, he says, never move on to the next trade until you find out why that trade lost. When you have a trade that lost, if you took a trade and the trade lost money, never move on to the next trade until you have figured out why the one that lost just lost, why the one that just lost you money lost. He said, when you do that, you'll be able to perfect your strategy be able to perfect your entries, you'll be able to get much better. It's like you're making deliberate efforts to get better at every trade you take. After every trade you take, with every trade you take, you're trying to get better. Very, very important, right? So this is the idea of correlation. So let's get started. Okay, so definition, correlation, currency correlation in Forex trading, you can take notes with this, so you can take screenshots, whatever you want to do is fine. So currency correlation in Forex trading refers to the relationship between two different currency pairs and how they move in relation to each other, right? Understanding currency pair correlation is important to Forex traders because it can help them make informed trading decisions and manage risk effectively. So this idea of correlation is so important because you need to know what you should not be trading together, what you should not be trading together, and what you should be trading against each other, right? When you take a particular trade, what else should you not trade? If they give you two signals and they say Euro USD is a buy and USD JP and then GBP USD, Euro USD is a buy and GBP USD is a sell, you ought to know that one of them is wrong. One of those trades is wrong. Without knowing, without looking at the analysis, without doing anything, you can already know that one of them is wrong because of correlation, right? So positive correlation. If two currency pairs move in the same direction, they are said to have positive correlation. For example, if Euro USD and JP USD are both moving higher at the same time, they have a positive correlation. So you see, it's very simple. If pairs are moving in the same direction, they have a positive correlation. Okay? So negative correlation. If two currency pairs move in opposite directions, they are said to have negative correlation. For example, if Euro USD is moving higher and JPP USD is moving lower, they have negative correlation. They have a negative correlation. I'm sure that's simple. If they move, one is moving higher, if Euro USD is moving higher and JPP USD is moving lower, they have a negative correlation. Okay. So measuring correlation. Correlation can be measured using a correlation coefficient which ranges from -1 to 1, -1 to 1, right? So a correlation coefficient of 1 indicates perfect correlation, right? So now when you are actually when you are in the market, you're not going to use the -1, the +1 and all that. This is for you to understand. This is just for your personal understanding of the concept of correlation, right? So when you have a coefficient of 1, it means that the pairs are perfectly correlated. Now you are going to, the only thing that is very important eventually as we proceed in this course, in this class, you will understand the pairs and the currencies that correlate perfectly together and the ones that have opposite negative correlation, right? Those are the things that are the most important things for you to learn. This is just like explaining more, right? This is just for a bit more understanding. Then you have negative, the coefficient of -1 indicates perfect negative correlation. So 1 indicates perfect positive correlation, while -1 indicates perfect negative correlation. And we've already established that some pairs go in the same direction, which is positive correlation. Some pairs go in the opposite direction, which is negative correlation, right? And then a coefficient of 0 indicates no correlation. So there are some pairs that have no kind of correlation or no kind of relationship. Another word for correlation is relationship. Another word for correlation is relationship, right? So this 0 means that they have no relationship, no correlation of any kind. Whether you're buying this or selling this, it doesn't mean there is no way they have a relationship with each other, right? That's when you have a 0 coefficient. So let's go and keep going. Importance for Forex traders. Forex traders can use currency correlation to diversify their portfolio and manage risk. For example, if a trader has a long position in a positively correlated pair, if a trader has a long position in a positively correlated currency pair, they can hedge their risk by taking a short position in the negative correlated pair. So what that means is this. Now, if you buy, there's what is called hedging. Hedging is a concept in trading, and hedging actually means that hedging means that you have a position on a trade running. Let's say it's a buy, and that trade goes against you. That trade, in order to prevent that trade from going against you massively, you can enter the same trade or a trade that has a positive correlation with that pair for a sell. So now let's say you buy Euro USD. Let's say in this case now, let's pick Euro USD and pick GBP USD, right? We pick Euro USD and GBP USD, and then they have a positive correlation, right? Euro USD and GBP USD in this case have a positive correlation. Positive correlation means that they have a positive relationship and that they go in the same direction. They move in the same direction. So let's say you are on a trade, you're on a Euro USD trade and it's for a buy, right? And that trade begins to go against you. That trade begins to go against you. That trade is not going your way, right? You can hedge your trade by taking a sell trade on GBP USD. So you have a buy trade on Euro USD and it's going against you. You can then enter a sell trade on GBP USD. So that's what we call hedging. So what you are doing is this: you know that one of them is going to, you know that when you enter one of those trades is going to go positive. Because when you enter a sell trade on GBP USD, you know that sell trade is going to go into positive. You know that sell trade, because Euro USD is going negative, GBP USD is going to go positive because of the positive correlation. So you now enter GBP USD for a sell in order to hedge your trading, your Euro USD trade that you made for a buy. So in that case, when you enter that GBP USD sell trade, you will start to notice that the negative trade that you have, the negative position that you have on Euro USD will start to reduce. Your trade will not be that bad. The initial Euro USD trade you took for a buy that was going against you will not be that bad anymore. The negative will not increase. The negative will not increase. In some cases, negative will start to decrease. The negative you have already on the initial trade will start to decrease. That's what you call hedging. Most of the time, hedging is done by companies that hold foreign currencies, right? For example, if you live in Nigeria or if you live in certain parts of Africa, you would have noticed that you would have seen how certain currencies in Africa have been devalued massively. For example, if you're in Nigeria, the currency for over probably a couple of years now has been very, very well devalued. So what happens is that can lead, if you are an individual, you can take all those losses for yourself personally. You hold your Naira. If you hold your Naira, 1 million Naira a year ago is much, much, much less than 1 million, how do I put it now? 1 million Naira several years ago compared in dollars is much less. There was a time a few years ago, I think 2 years or 3 years ago, $10,000 was about 3.6 million Naira in Naira. Right now, the same $10,000 in Nigeria is about 7.5 million. Right? So, but this can be for individuals that is not, as an individual who is not holding dollars or holding Naira and all of that, or you are just transacting with it, or you just use it to live your life. I'm using Naira as an example. I'm aware that some other people on this class are not from Nigeria, but I'm just using that as an example, right? So, so now as an individual who is taking this, who is using the currency to live your life, it may not bother you so much, apart from the fact that it affects you when it comes to inflation. But if you are a business person, if you are a company that has to import goods, and you sell your products in Naira, you are a manufacturing company. Let's say you're a manufacturing company in Nigeria, and then you import raw materials to manufacture goods, and these raw materials, you buy them in dollars. Okay, but the products that you are selling within the country, you are selling it in naira. When you take those nairas and you decide to keep your naira in the bank, what happens to that naira over this period of time? Your naira will begin to lose value, which means you'll be losing money just by keeping your money in the bank. So what companies now do is that they hedge. They will not buy another currency. They will hold their money in a different currency, not because they want to make more money on it, just to make sure that that currency devaluation does not affect them, right? So this is what is called hedging, right? I don't want to spend so much time on that, but basically that's what hedging means. So market factors. Currency correlation can be affected by various market factors, such as interest rates changes, economic data releases, geopolitical events, just like what's happening in Turkey and Syria right now, the earthquake that just happened there, right? I'm sure some of us might be aware of the huge 7.8 magnitude earthquake that just happened in Turkey and Syria a few days ago, killing thousands and thousands of people. And the death toll eventually is going to get up to 20,000 people, right? It's one of the worst earthquakes ever to have happened in the world. I think that magnitude of earthquake has only happened twice before, right? So that's what we call geopolitical events, black swan events. Black swan events or geopolitical events. These are events that happen in the world that you never planned on. There was nothing in the economy or nothing in the world that showed that thing was going to happen. Just like the Russian-Ukraine war too is another such geopolitical event. So these events tend to be able to affect currency prices and make certain things happen, right? And the reason why that happens is that whenever such an event happens, there's a way it affects currencies and commodities. For example, an example is Ukraine and Russia. Russia had exports over 10 million barrels of crude oil every day. So Russia is like second or third largest exporter of crude oil every day. Now, by the time Russia invaded Ukraine and the West, America and the rest of the West started imposing sanctions on Russian oil, what do you think was going to happen? It will affect crude oil, right? It will affect crude oil. And remember, we have people who are crude oil traders. It will affect crude oil. And then what used to work in the normal way as it's supposed to work, the market will just change. That's what we call geopolitical events. They are very, very impactful. Something will just happen. Sometimes they are called black swan events. It happens. It's not something that anybody plans for. It's not something anybody knows or anticipates is going to happen. Right? So these have the ability to change the dynamics of the market, both for currencies, for commodities, for indices, and all kinds of instruments in the market, right? So whenever those things happen, as traders, we don't just ignore them, right? It may not be good, it may not feel good that, a negative event is happening in the world that probably kills people and somebody else makes money from it. Well, it's not like you are happy that something like that is happening, but the fact is that there's still money flowing in the market. You are just doing your job as a trader, and you trade and you take profit, right? So it's not as if you are happy that something evil is happening to somebody. You're just doing your job and taking profit, even though you are sympathizing with those who have those issues happen to them, like in Syria and Turkey right now, right? So this is the first example when it comes to correlation. So positive correlation between USD CAD and crude oil prices, right? So USD CAD has a relationship with crude oil prices because Canada is one of the largest exporters of crude oil. Canada exports more than 4 million barrels of crude oil every day. Yes. Canada exports more than 4 million barrels of crude oil every day. So crude oil is a major stay for the Canadian economy, even though the Canadian economy is not too big compared to certain countries in Africa, but they export more oil than many, many big countries that we hear of that say they have oil, right? So because of that, the USD CAD has a relationship with crude oil prices. Okay, so let's see this. It says the Canadian dollar is often referred to as a petrocurrency because of the country's large oil reserves. As a result, the USD CAD and crude oil prices tend to have a positive correlation. You see, so that means USD CAD and crude oil have a positive correlation. When crude oil prices rises, the Canadian dollar tends to strengthen. And when crude oil prices fall, the Canadian dollar tends to weaken. Okay, so there's something here. When we say it's as a result, this USD CAD, the USD CAD is not here. There's a little bit of a mistake, right? So it's actually CAD that has a positive relationship with oil, not USD CAD. Okay, it's Canadian dollar itself that has a positive relationship with crude oil. So what you will notice is this: CAD has a positive correlation with crude oil. So when crude oil rises, Canadian dollar tends to rise, or when Canadian dollar rises, the crude oil tends to rise as well, right? But USD CAD is different from CAD. USD CAD is different from CAD, right? Why is that? There's what is called, so many of us know, there's what's called base currency and quote currency. Whenever you see a currency pair and you see the one on the left is the dominant currency in that pair, the one on the left is the dominant currency in that pair. That's why it's called a base currency, right? So, and then usually what happens is that the one on the right, on the left, goes opposite the one on the right. So whenever you see now that in this case, now we have CAD is strong with crude oil. So CAD has a positive relationship with crude oil, but USD CAD has a negative correlation with crude oil. The CAD itself has a positive correlation with crude oil, but USD CAD has a negative correlation with crude oil, right? I don't have a way of writing on this screen, so I would have explained a bit more than that. But let's look at that again. Go through that again that I just said now, and then you start to understand, right? So that's why right now, when you go to the chart, you will see that crude oil is actually buying today, and USD CAD is selling today. As I'm talking to you right now, you can go check the chart. You will discover that crude oil is buying heavily today, and USD CAD is selling heavily today. That is opposite direction. But that actually means that the CAD itself, which means the Canadian dollar itself, has a positive relationship with crude oil. It's just because that in this pair, it is on the right-hand side. So let me give you an example. Go and check right now what CAD-JPY is doing. CAD-JPY. When you go right now, go and check CAD-JPY and check crude oil. You will see almost the same relationship. You will see them doing almost the same thing. CAD-JPY and crude oil. Go and check it right now. You will see that they are both buying. And why are they buying? Because crude oil in that currency pair called CAD-JPY, CAD is the dominant currency because it's on the left. It's the base currency. So when it's the base currency, that's when you actually see the strength of it, right? You actually see the strength of it. If it's on the right, which is in the quote currency, it begins to go, it does the opposite of what you think it should be doing in this case. I hope I'm making this clear. I hope we are clear about this. But see what I'm saying? Go to USD CAD right now and check it against oil. You will see that the relationship is opposite. But when you go to CAD-JPY right now, CAD-JPY, and compare it to crude oil, you will see that they are doing the same thing. So CAD itself, Canadian dollar, has a positive correlation with crude oil. So let's go on. So negative correlation, Euro USD and USD CHF. So Euro USD and USD CHF have a negative correlation. What this means is that if you are buying Euro USD, you should be selling USD CHF. You cannot buy Euro USD and buy USD CHF at the same time, even if your signal, even if your analysis or your strategy tells you to do that. If your strategy tells you to do that, the truth is that your strategy is going to be wrong on one of those two trades. Because why am I saying this? It happens sometimes. You will think that the market is telling you to buy one and sell, buy both of them at the same time. There are times the market will look as though you are seeing a signal of buy and buy Euro USD and buy USD CHF at the same time. At that time, you need to know that one of those signals is wrong. Yes. You will now know that one of those signals is wrong. You cannot be buying Euro USD and buying USD CHF. They have a negative correlation. What that means is that they move in opposite directions. So positive correlation means that they are moving in the same direction. Negative correlation means that they move in opposite directions. So when you are buying Euro USD, you know that you are going to look for sell opportunities in USD CHF. You see? So when you see a buy signal on Euro USD and you see a sell signal on USD CHF, you can enter. You can enter the buy on Euro USD and enter the sell on USD CHF. Both of them will make money. That's the meaning of currency correlation. That's the meaning of negative correlation. So the Euro USD and CHF currency pairs have a negative correlation because they often move in opposite directions, right? This is because the Swiss franc is considered a safe haven currency, and when investors are worried about economic and geopolitical events, they tend to flock to the Swiss francs, causing the Swiss francs to rise. On the other hand, when investor sentiment is positive, they tend to shy away from the franc, causing the USD CHF to fall. Yes. You say at the same time, not necessarily at the same time. No, not necessarily at the same time. If you are buying Euro USD, you don't necessarily have to sell USD CHF at the same time, but you know that they are going to sell. Euro USD is going to buy, and USD CHF is going to sell. But what you may notice is that when at the time you get a signal for a buy on Euro USD may be a bit different from when you get a sell signal on USD CHF, but you can wait for it. You wait for it because as long as you are seeing a buy on Euro USD, you know that USD CHF is going to give you a sell. But then you might not have to check and wait for it to see, okay, is it giving a sell now, or should I wait a bit more before I get that sell signal? So it doesn't have to be at the same time. It could be at the same time, but it still may not be at the same time. The most important thing is not that it happens at the same time. The most important thing is that you understand what is going to happen with both of them. You see? Exactly. So the most important thing is you understand what's going to happen. One is going to go in one direction, the other one is going to go in the opposite direction. It doesn't have to happen at the same time. Okay, let's keep going. So example 3, we have positive correlation between AUD USD and gold and NZD USD. So AUD USD have a positive correlation with gold, and AUD USD has a positive correlation with NZD USD. So the NZD USD and the AUD USD economy are very, very, very intertwined. They are actually very close. They have a close proximity, and both of the economies work very, very, they depend on each other a lot. They have the same kind of natural resources. Okay, the Australian dollar is often positively correlated with copper and gold prices because Australia is a major producer of copper, and the value of AUD is directly linked to the performance of the country's commodity exports. All right, so Australia is one of those countries that have a lot of heavy metal exports, right? Like copper, like gold, and all of that. The biggest miners of gold in the world have their production factories production facilities in Australia, right? Okay, so I can't remember. There's a major one I wanted to remember, but I skipped my mind now. A major company that produces gold, they produce a lot in Australia, right? The same thing goes for New Zealand. That's the reason why you see AUD USD and NZD USD have a positive correlation, right? Their economies work a lot together. the NZD economy also has a lot of metal production, a lot of agricultural production, and all that connected to the NZD economy. So the NZD, you will see that AUD/USD has a positive correlation with NZD/USD and also has a positive correlation with gold. Why positive correlation with gold? Because the economy is based on a lot of gold production. So when gold does well, AUD, the economy, the Australian economy does well. When gold does well, the Australian economy does well. So that's the positive correlation. So if AUD is buying, gold will be buying. If AUD is selling, gold will be selling. You can check your chart, you'll see what I'm saying. Okay, when AUD is buying, gold will be buying. When AUD/USD is buying, gold will be buying. When AUD/USD is selling, gold will be selling. Right now, this correlation we're talking about is not to the T. Most of the time, it's not to the T. Right? It's a directional thing. Sometimes it will be to the T, which means that you are seeing a buy candle on one pair. Let's say you have a negative correlation. You are seeing a buy candle on one, you are seeing the same sell candle on the other one. Or they have a positive correlation. You are seeing a buy candle on one, you are seeing a buy candle on the other one. Sometimes it happens like that. Sometimes it doesn't happen like that. Right? But it happens by direction. You just know that, okay, as long as AUD/USD is buying, NZD/USD is going to buy. So you now look and say, okay, if I have a buy signal on AUD/USD, I also know that I'm going to buy NZD/USD, but do I have a buy signal yet? Then you have to look, just like I explained earlier, it doesn't have to be at the same time. But what you do know is that both of them are going to go in the same direction. But at what time, the difference between them is not going to be much. I'll show you that. The difference between them in terms of time is not going to be much. If you see a buy signal on one, it won't be long before you see a buy signal on the other one. Right? So that's basically the way it is. And it's not like AUD has to lead the way. No, it doesn't have to be like that. NZD can lead the way. Gold can lead the way. Any one of them can lead the way, just that they have a positive relationship. Whichever one happens first, you know what's going to happen on the other one, right? So you know what's going to happen on the other one. For example, 4 currency pairs that always go in the same direction are Euro/USD, GBP/USD, AUD/USD, and NZD/USD. These 4 currency pairs will tend to always go in the same direction. Apart from GBP/USD that can deviate from that group sometimes. It's only GBP/USD that most times can just take its own, can have a mind of its own. But you find out that Euro/USD, AUD/USD, NZD/USD, most of the time will go in the same direction. Most of the time. GBP/USD will also follow them, but sometimes GBP/USD, because of the strength of the British economy, because of the strength of the British economy, sometimes some major things can happen in the British economy that will just derail the pound and make the pound do its own thing, right? But most of the time, you will find that these 4 currency pairs, they usually have a good quality relationship and correlation, right? So this is another one. So you have negative correlation between GBP/USD and Euro/USD, Euro/GBP. So check this, you will discover that every time GBP/USD is buying, Euro/GBP is going to be selling. Every time you see GBP/USD buying, Euro/GBP is going to be selling. Every time you see Euro/GBP selling, you see USD/JPY is going to be buying. So GBP/USD is going to be buying. So they have a negative correlation, opposite relationship. This one is so easy that in fact, if you ever trade these 2 pairs and you did not even know about correlation, you will suspect that there is a correlation between them. Because you will always notice that when one buys, the other one sells. When GBP/USD is buying, Euro/GBP will be selling, and vice versa, right? You will see that. That's when you start to even ask questions. If you trade these 2 pairs together, you will start to ask questions. Is there a relationship? You may not have even known that there's something called correlation, but you start to notice a relationship between them. Okay, this one is very glaring. So when you check that, whenever you want to trade these 2 pairs, make sure you're not trading the 2 of them in the same direction. You can't be buying GBP/USD and buying Euro/GBP at the same time. It will not work, right? It will not work, right? Even if you think you are seeing a signal together with them, even if you think you are seeing the same signal on both of them, one of them will fail, one of them will lose, right? That's how it is. Then JPY has a positive correlation with gold and silver. JPY also has a positive correlation with gold and silver. Very important. JPY has a negative correlation with crude oil because it's a major importer of crude oil. So why this happens is that the Japanese economy is one of the largest importers of crude oil in the world. So what that means is that whenever the price of crude oil is low, the Japanese economy will benefit from that. Whenever the price of crude oil is low, the Japanese economy benefits from that. But whenever the price of crude oil is high, the Japanese economy takes a hit from that because now they have to pay. The government has to pay more for the same crude oil. You see, that's why there's a negative relationship. If the Japanese economy was a producer of oil like Canadian economy, you will see that they will have a positive relationship. The JPY and crude oil will have a positive relationship. But now that they don't have a positive relationship, one, because they import oil, so whenever the price of oil is high, it will affect JPY. Whenever the price of oil is low, it will affect JPY too, in a positive way in this case. So for this reason, you will notice that USD JPY and crude oil seem to go in the same direction, just like we said before when we talked about base currency and quote currency. JPY has a negative correlation with crude oil, right? Because JPY, the Japanese economy imports a lot of oil. So it has a negative correlation with crude oil. But USD JPY has a positive correlation with crude oil. So USD JPY has a positive correlation with crude oil, but JPY itself has a negative correlation with crude oil. So when you go to the chart now, you check, you will discover that crude oil, when crude oil is buying, USD JPY will be buying. When crude oil is buying, USD JPY will be buying. When crude oil is buying, USD JPY will be buying. You can check your chart today, you see these things. When crude oil is buying, USD JPY will be buying. So when we talk about crude oil, we're talking about WTI. WTI is American oil, is US oil. And then we're also talking about Brent crude. Brent crude is UK oil. UK oil is Brent crude. UK oil actually has a higher price. Currently, I think UK oil is selling at around 80 something dollars today. Then while US oil is selling for about 70 something dollars, right? So US oil is American oil. It's also called WTI, which is West Texas Intermediate. That's why it's called US oil. West Texas Intermediate. That's the name for the US oil. UK oil is called Brent crude. Brent crude, right? Brent crude. So you might check on the chart, you might see Brent, but on our platform, on Vantage platform, you will see US oil as USOUSD, which is US oil, right? USOUSD. For UK oil, we see it as UKOUSD. UKOUSD. So that's UK oil, right? So they move very massively, they move aggressively and all that, right? So this is what we mean by correlation, and this is how you think about the chart. Whenever you approach the chart, you come to the chart and you're looking to pick an asset to trade, you want to make sure that you are not trading so many different things. This is also one reason why it's important to trade only a few pairs, because sometimes you may not be able to track all these different movements if you trade too many different currency pairs, right? Like we were discussing on the chart yesterday. All right, so do we have any questions?